Both the IMF and Asia Development Bank have recently cut their Chinese growth forecasts. Karina Huber spoke to Standard & Poor's analysts Tsang and Christopher Lee to look at the risks faced by the country's banking sector and its top companies.
At 7.5% growth, we believe the banks will still see some pressure. In the next couple of years, we think the Chinese bank will come under a lot of tough time, and they will be tested by the high non-performing loans and squeezed interest margin.
Do you predict much consolidation in the bank sector?
Yes, we believe the polarization of the banking sector will continue, and we will continue to see some consolidation. And this time around, it's not going to be a government-led consolidation like what happened like for the past 5 years. It's more likely to be a market-driven consolidation.
And which are the banks that are most vulnerable?
Primarily the smaller banks that rely heavily on net interest income. Those banks without a niche market, they are most vulnerable to the squeeze on the net interest margin and the rise in credit costs.
And how severe is the worry? Should Chinese consumers be concerned about the banks that they do business with?
Well, that we do not see as a big concern, primarily because we think the government is likely to be behind for the big banks. So what is likely to happen is there may be some flight to quality should there be any worries about the smaller institutions. However, the system as a whole, though, we do not see a big banking crisis coming up.
Christopher, what do you think of the financial risks for the 107 top companies in China? 80% of them are state-owned enterprises. What are the risks for them?
Well, in our view, the top China corporates in our study, the 107 companies, the financial risks are above average. That means most of them have somewhat high leverage and weak cash flow and profitability. But that also reflects, number one, that they are state-owned. Number two, some of these companies undertake non-profit activities. And also, they have very good access to banking at low cost, bank credit at low cost. So as a result, the ownership structure and also the cost of capital means that they have a preference, natural preference, to borrow, and therefore a high leverage in the financial profile.
And how should an investor react to this information you're giving us right now?
Well, I think in a slowing economic environment where we are seeing lower prices and lower sales volume for most companies, and as a result, a margin squeeze. So for those companies with an above average financial risk profile, that means they need to monitor the cash flows very, very, very carefully, and also need to reduce their leverage in order to weather this downturn.
And what are the sectors that are the most risky right now in terms of their credit?
Well, there's some of the sectors that in our study basically are those that are involved in infrastructure development that requires large capital expenditure, that takes a long payback period, and also companies in construction and engineering because of the slowdown in the economy that are also seeing a decline in the order books.